Let me look at Coatmin. Look at Coatmin. Coatmin is a government-controlled bank. Coatmin was taken over by the government during the recent financial crisis. Coatmin doesn't directly trade with other government-controlled banks, but has underwritten to develop nationally owned railway, postal service. The directors of Coatmin are concerned about the volume and cost of a disclosure. Volume and cost of disclosing related party interest because it's extended theoretically to all government-controlled enterprise and banks. They wish general advice on the nature and importance of the disclosure of related party relationships and specific advice on disclosing the above relationship. Well, this is about disclosure. Okay, when you have a disclosure question, this is about IS 24, right? Do you know what is IS 24? So it's about related Does that make sense? approach the answer now. Remember you said disclosure, what type of questions for disclosure? This is the question for disclosure, got it? Make sense? They asked, should I disclose everything? And you went like, no need, you don't need to disclose everything, got it? You can relax it down a bit. Why can you relax it down a bit? Well, because there is an aggregation rule, okay now? There is a concept called aggregation. Understand this concept? Concept called aggregation. This idea of aggregation, which we've used somewhere else before. Where have we aggregated before? Anybody knows where we've used the concept of aggregation before? Segmental reporting. Inside segmental reporting, when the economic characteristics are similar, we kind of aggregate it. We also use aggregation in, guess what, deferred tax and financial liabilities. Asset. In financial liability and deferred tax, it's called offset. You aggregated lah. See, same idea. Got it? So the principle of aggregation. Understand the principle of aggregation? Huh? There are a few core principles. You're saying, like the principle of business model, the principle of monetary and non-monetary. Are you clear or not? These are like major ideas. Huh? Make sure you understand this idea. Huh? Why do you disclose? Why do you disclose? To help people understand better. The principle of understanding. You disclose the information when people need to understand something. Clear? Like for example, the aggregation concept in biological asset. We show an aggregated biological asset. We don't show a separate biological asset. We don't show, we got apple farm, we got cows, we got sugar cane. We don't show them as separate entity. We just show as one single biological asset. Are you clear now? We aggregated the amount and showed it into the financial statement. But because it's aggregated, people may not understand the risk and issues related to your biological assets. You need a separate disclosure. The disclosure helps you understand the aggregated amount. Does that make sense? Follow, don't follow? Any questions here? Can now? Make sense? Okay. The next question is a bit tricky question. This is a very, very difficult question. Okay. But anyway, it's a good example question for you to learn this item, something called financial guarantees. Now, financial guarantees is something that I said that I will come to when I taught it to you. I said like it's a complicated item, but I will teach it to you when I reach revision, which is what is happening right now. This is under /revision/teach. I clear not this question. It's because you want to learn what is the concept of a financial guarantee. What's the concept of financial guarantee? That's like you give a guarantee to somebody. Clear? Usually there are two types of guarantee. Bank gives guarantee, yes or not? Does bank give guarantee letter? Do they give it for free? They will charge money, right? So when they charge money is revenue. Huh? Under revenue, no. Special category. That's right. If you look back at the note, it said IFRS 15. Treat under IFRS 15 or treat under IFRS 9. It said look at it and decide which one you want to treat under. Correct? So if the bank give a financial guarantee, they normally charge money on it. It's like, okay, I give you this much guarantee, but I'm going to charge you this much. So they start earning money on the side here. So they start recognizing the revenue aspect of it. Are you clear now? But parent and subsidiary might give a guarantee. So, parent company might give a guarantee to a subsidiary saying like, don't worry, we'll take care of your financials. Correct? So that's another financial guarantee contract. Okay. So now, at the start of the financial year, 30th November, Coatmin is a bank, right? Coatmin is a bank, correct? Because it got taken over by the government. Clear? Coatmin gave a financial guarantee contract on behalf of one of its subsidiary. Pay attention. It gave a financial guarantee contract to its subsidiary. So this is parent giving to sub, not bank giving to client. Okay. A charitable organization committing to repay the principal amount of 60 million if the subsidiary defaulted on any payment due under the loan. The loan related to financing and construction of new office premises and has a term of 3 years. It is being repaid by equal annual installment principal with the first payment having been paid. So first payment made lah. 3, that means 60, 20, 20, so 40 lah, 20, 20 lah. 3 payment or 60 million, make a note that. 3 payment should be 20, 20, 20, got it? Okay. Coatmin has not secured any compensation in return for giving guarantee. Pay attention, Coatmin have not secured any compensation for the guarantee. Clear? But assessed it at a fair value of 1.2 million. So at the initial date it was 1.2 million. If they keep paying everything, it should just go down 1.2 divided minus 0.4, 0.4, 0.4, 0 already. Clear? It had an initial fair value of 1.2. The guarantee is measured at fair value through profit and loss. They already said fair value through P&L. That's something like easy for you. So you know you're going to start with a 60 million, you're going to start with 1.2 million. 1.2 million. Is it asset or liability? It's a liability, right? All you need to know is already in your hand already. So when you started this one, debit, credit, what? When you started this one, how you debit and credit? Debit P&L, credit FL. When they paid they paid 20 million, your financial liability should reduce, right? Debit FL, how much? 0.4. Credit P&L, 0.4. You're kind of reversing it out. Are you clear on this logic? Question can get complicated, but all you need to anchor is what is the basic treatment. Once you know the basic treatment, it always follows the general treatment you study. It cannot run away from those treatments. Are you clear now? Don't complicate issue. Okay, now, so in this case, the guarantee was given a basis that it was probable that it will not be called upon. On 30th November 2004, Coatmin became aware of facts that subsidiary is having financial difficulties, and with the result that it has not paid the second installment. Oh, it didn't pay the second installment, okay, of the principal. It assesses the probable that the guarantee will now be called. The guarantee will now be called. That means I have to pay how much now? 40 million. Clear? 40 million, okay. Called upon. It is now anticipated subsidy. Okay, then the subsidy secured donation which enabled it to make a second payment before guarantee was called upon. It is now anticipated the subsidy will be able to make the final payment. Discounting is immaterial and the fair value of guarantee is higher than the amount of loss allowance determined in accordance with IFRS 9, revised by July 2014. Rules on expected credit loss. Coatmin wished to know principle, okay, keyword, principle behind accounting for the above guarantee and how the transaction should be accounted in the financial record. So we're just going to go into this one. It's a kind of like a mix item, right? It's a mix item. So when you have a mixed question like this, you go like, okay, what am I going to do? I'm going to talk about a little bit on measurement, a little bit on recognition. You got a few transactions you need to be worried about. Let's do the dates. Okay, when you can do it by journal, you should be roughly correct already. Can you do it by journal first? Okay, let's do the journal entry for this one. This one I can just do a way of answering this one slightly different. This is B. Okay, journal entries. Journal entries is kind of like your workings, got it? So on the 1st December, what happened? You get the guarantee, yes or not? Debit P&L 1.2, credit your financial liability 1.2. Does that make sense? Giving the guarantee. Follow? At 30th November 2000X3, you're going to reduce the liability. Does that make sense? How much? Then what happened on the 30th November 2000X4? How much is due? 40 million, right? But you already got your financial liability how much? 0.8, right? So you need to top up. How much you top up? 39.2. Are you clear with this idea? Yeah, well, you're going to pay 40 million, right? Are you clear with this idea that you're going to pay 40 million now? And then you credit your... Does that make sense? It's going to be a call already, what? There's a chance that we're going to call already, right? The guy missed the payment already, what? Hey, sorry. This one is financial liability. Clear? So far, any question? Cannot. Understand this one? No? Makes sense? Then what happens? What happens after that? Well, why 39.6, you know, right? 0.4 is still being amortized. Clear?
So no need to show it.
No need.
No need to speed.
Ah?
No need to speed.
Alright, understood lah. Record payment was made and follow, don't follow? Every year what? They already made the second year payment what? Once the second year payment finishes, you don't need to hold the second year worth of the value what? 1.2, 0.4, 0.4, 0.4 becomes 0, correct? So you make 3 payments, you don't need to have any more guarantee reward. Follow, don't follow? Okay, do you know what was the 1.2? The 1.2 is your estimate of the probability of they making the call. They can't make the payment. You fair value it at 1.2 million. Make sense? Doesn't make sense? Clear or not clear? Got it now? Okay. That's about that one. But now you have to write this in basic English. How to write down is basic English? That's the one that you little bit. Okay. You can say the above provides the entries that would have been needed to account for the guarantee. Financial guarantees are initially fair value and subsequently measured higher of Done. Clear? Not clear? I still remember hedging now. What's the rules for hedging? Have you memorized the rules for hedging? Hey, you're supposed to memorize your rules for hedging. What's your rules for hedging? Hedge effectiveness criteria. Some more? Some more? Relationship. One more is documentation. RED. I have to memorize it as RED. Remember? So remember it. Okay, let's move on to the next question. This one's done. That's all. Can I move on? Follow, don't follow? Clear? Coatmin's creditworthiness has been worsening, but it has entered into an interest rate swap agreement which acts as a hedge against 2 million 2% bond which matures on 31st May 2006. Well, hedge against a 2 million bond. Coatmin wished to know circumstances in which you can use hedge accounting. In particular, you need advice on hedge effectiveness and whether this can be calculated. Okay, 7 marks. Hedge accounting. There are qualitative criteria that have to be met before hedge accounting can be used. Condition is that that's the red. Remember red? Relationship. Then you got effectiveness. And then you got documentation. Remember? RED. RED, yeah? Hedge item and instrument. Right, that was for the hedge effectiveness. Got it? Follow, no follow? That's it. That's all the examiner asked for. He didn't give you any issues about describing the hedge item, hedge instrument, nothing. So he just told you I entered into an interest rate swap. Follow? Follow, no follow. Can. Hedge hasn't come up for a long time. In fact, hedge can be a current issue. Hedge can be a current issue. Got it? Okay. Next one you got there is going to be last one. Coatmin provide loan to customers and funds the loan by selling bonds in the market. The liability designated as fair value to profit and loss. The bonds are have a fair value increase of 50 million in the year 30th November, of which 5 million relates to reduction in Coatmin's creditworthiness. How to account for the movement of 4 million? How to account for the movement of 5 million? So how do you account for the 5 million movement? What is the 5 million movement all about? Well, it's not. It depends. Let's look at this part D. How they measured it? Financial liability designated as fair value through profit and loss. Usually, all market movements will be passed through P&L. Does that make sense? However, credit risk changes are not usual occurrence and is accounted via OCI. So how are you going to account for this? David, you are? Is this gain or down? Up or down? The bonds selling bonds in the market. The bonds have a fair value increase of 50 million. Does that make sense? That means the cost has gone up by Does it make sense? Yeah? It's a financial liability. This is where people got confused a bit. Read the question properly. They bought. Coatmin provide loan to customer. When they provide loan to customer, the customers are your financial asset. Okay, and funds the loan by selling bond. When they sell the bond is your financial liability. Clear? Okay. The liability is designated as fair value through profit loss, which can, because of accounting mismatch. If you measure the customer accounts in fair value through P&L, you can also measure the liability in fair value through P&L. This is called solving an accounting mismatch. Yeah. Can? Do you understand how to handle this one? Yes, no? Yeah. Huh? Why debit OCI? IFRS 9 says, if the changes are not market based, one-off changes like credit rating changes are one-off, not regular, don't confuse the user. The user needs to know what is market based and what is not market based. So a credit rating change on the bank causes the change in valuation. Change in valuation will then trigger something as one-off. So you don't want that to be, the user to get confused as normal performance. Clear? So you put it under OCI. Kind of like removing distortion in performance. The financial liability went up, but it didn't go up because of the market. It went up some because of market, the 45. The 5 was because the bank credit rating dropped. Clear? Yeah? That covers